Okay, so what you're looking at here is the basic power options trial. For those of you who are just getting started, I encourage you to take advantage of the 4 steps listed. You can get the free start guide. There's a variety of free flash tutorials that you can go through. And of course, we host some free webinars during the week, and our archive webinars can be accessed at any time. Don't worry, I am sure I'll reference that page during today's presentation. Trial members and subscribers, remember you can sign up for a free coaching session at any time. All right, let's jump right to it here. Sam, of course, wasn't with us last week. He says hi to all in the room. He had a nice profitable week with the flat markets. Income trades was all worthless today. Doing bull puts on Apple, Netflix, UVXY, MU, and INTC. Fantastic. Yeah, I think most of my bull puts that we were looking at from a couple of weeks ago on the 2nd of March that were open for the 16th expiration today, all expired as well. Okay. And so Sam says he wasn't feeling well last week. I'm sorry about that, Sam. Let me just take a look at the portfolio tools real quick here. I didn't adjust them. There we go. And that's something we might look at later today. All right. Yep, so the 3 married puts that we had here, oh, not the 3 married puts, I'm sorry, the bull put credit spreads, they all expired. And the calendar spreads, let's see, my 114 call was adjusted. I didn't put it into the portfolio. We're going to do that in the presentation. And the 112 call here on Texas Instruments expired, and I'm still holding the April 105 for both TROW and 105. The credit spreads expired, worthless, and these VIX calls are essentially nothing. That's just an extra hedge. Okay, so I just wanted to get into that as well. All right. Ruth asked, if you're running out of time on an option and you're in a loss position, can the option be extended as to get additional time? Of course, Ruth, it can be. It absolutely can be. But the question is, what kind of position is it? Either way, you can adjust it and extend it. If, and only if, you still think the stock's going to recover over time. What do I mean by that? I had a covered call that expired worthless today on Amrit. I had sold the 61 call for the March 16th expiration for $1.05. I don't have it on here. Should have put it in, but it expired worthless. Now, let's say we did the opposite, Ruth. Let's say 2 weeks ago, on the 2nd of March, I opened the April 61 call for a cost of 105 when Amrit was about at 60.81. Okay? Now the stock has fallen to 59.64. I'm probably hurting on that position. I think Amrit is going to recover long term. What might I do? Let's start from the beginning. I'm going to go into the chain for power options. I'm going to look at Amrit, applied materials. But on the trial, I have the advantage of 3 months of back testing. So I'm going to go back to March 2nd for the option chain. We are just going to look at calls. And, well, the stock was at 58.03. So let's take a look at the stock chart. I want to find a better time. I thought I entered it on the 2nd. Likely would have been here. The 2nd. So let's go to March maybe 9th, March 8th, March 9th. Okay, sorry about that, Ruth. I had my dates mixed up there. But let's try March 8th first. Okay, so let's see what the price of Amrit was on the 8th. 59.37, not enough. It was higher. That was too high. So I think it was done before that because I almost had to roll that call, but I chose not to. Let me go back. We're going to use that. So on the 6th, the 61 call, yep, there it is, 90 to $1. So let's say I was bullish on this stock, Ruth. I bought the out-of-the-money 61 call on Amrit, only 10 days away. Normally, I would go much longer on that position, but we want to talk about running out of time, okay? And so on March 6th, when Amrit was right at 60, we would have bought the 61 call for $1. All right, now let's go to the custom spread tool here. Take a look. First thing I'll say about this long call position, Ruth, is that in general, I would have rolled this position much sooner. Okay, look to adjust it look to kind of get some benefit from it. But remember, we bought it, and we're just going to use one contract to keep the math simple. So we bought this at $1, risking 100% of what we invested on the position. $100 for one contract, not a lot. We would have used proper position sizing, of course, as well. Now, let me pull up the chart one more time for us. And what we're kind of saying is that around here, so it would have been second, third, fourth, fifth, right around here is when we got in. Okay, and that long call was looking pretty good. But right about here, 2 or 3 days ago, it pulled back. Okay, we're going to have to come up with something creative. Let me go back to the chain one more time. I'll leave that open, but let me go back to the chain one more time. And what I want to take a look at is just a day-by-day movement. And what I mean by a day-by-day movement is we're going to go back to March 6th one more time. Look at the 61 call for March 16th. I'll change this to calls only one more time. All right, so we got March 16th. We're back on March 6th, calls only. Here's the 61 call. In general, when I open a long call, Ruth, I'm going to set a stop of some kind. Let me start with this. I know I'm detracting a moment, but I had this planned in case there weren't a lot of questions coming in, something I'm working on for Thursday that I think you really ought to see. But I want to launch a quick poll here. I don't normally do this, but if you're buying a call or buying a put, speculating on a market movement, whether the call or put 15 days out, 20 days out, 30 days out, you know that if you buy a stock, IBD and others recommend you put a 7% stop order. If you're trading a covered call, you'd put a 7% stop on the stock. Okay? But with a long call, you can't set a stop that low because you're going to hit it immediately just with the bid-ask spread. So I'm curious to know, we're going to take a look at this with the Amrit position we paid $1 for on March 6th. Where would you set your stop if you bought a call? Would you set it at 25%? Would you set it at 33%? Maybe around 40% or so, 35 or 40%, or would you set the stop at 50%? Okay, and so we got some good answers coming in. I thank you for contributing to our poll today. But I've had it open for about a minute. I know there's other questions that are there, so I want to go ahead and get to the other questions. I don't want to leave the poll open too much here. It's about what I'd expect. Oh, I'm sorry. It says 8%. Oh, no, it doesn't. If you write in a different number, 1 or 2 people voted a different number, just send that in the question pod. I'll take a look at that in a moment. But let me go ahead. If you haven't voted yet, it's okay. Let me go ahead and close the poll, and I want to share the results with everyone. Okay? So it's a nice mix. 23% of you would put a stop at 25%. I'm going to confuse myself saying this. 23% of you would have put a stop at 33%. 15% of the audience would have put a stop at 40%, and the winners, 31% at 50%. Okay, 8% said a different number. Let me scroll through the comments here. If you answered a different number, what is your stop? Okay. Isaac, I see your question. Great question there. Just 1 second. John, tough. John set a stop on his calls at 10%. You see the problem right away, John, in my mind, doing it that way. And Sam says normally buys puts or calls to replace his stop. So he's kind of legging in. Yeah, we'll talk about some of Sam's positions in a little bit too. So he sort of legs into straddles and strangles short and long from time to time, or has a short put for premium, uses a long put to protect it sort of in a bull put or a different position. Okay, fantastic. Thank you, everyone. Let's get back to it. The reason why, John, I mentioned 10% is tough, although I appreciate your skill of limiting risk as best as you can. Look at this when I opened it. On March 6th, the bid was 90, the ask was $1. If my broker is hard edged and I'm forced to go to the ask and I pay $1 and they base the close price on the bid, I'm already at a 10% loss when I open the position. Of course, using power options, you can structure the bid-ask spread to be much lower. But in any case, let's go forward. Now that we know our numbers, let's go forward. The next day, Amrit dropped to 59.42. The 61 call, let's call it at 70 cents. We're already down 30% on that position with a 50-cent drop in the stock, or almost a 1% drop in the stock, because it was short term. Many of you who answered that poll, I'm sure you're buying further out long calls, but I might use this later on as well. So the 23% that set your stop at 25, you're already out of the position. And there's nothing wrong with that. You might not even use this as a hard stop. It might be a point to manage your long call. Let's go to March 8th. Stock's down again, not much. We're losing some time value. It's now at 50 to 56 cents. We'll say 56 at the ask and be nice. 33% loss is triggered, 40% loss is triggered, 50% loss is triggered as well. Everyone's essentially out of this position in 2 days. I'm cheating because it's a weekly long call, which I wouldn't do anyway, or 14 days. Again, I usually would have bought it further out in time so the time doesn't go against me, okay? And then it bounced back up. Now we're happy. We're at a 40% gain. Stop jumped up to 61.61, $2.24 on the 9th. Next day going forward, but we would have been out of it. All of us would have been out of the trade based on what you set for your stops, those of you who answered the poll. And then we're still at a 45% gain here, 60.97, so it's still good. All right, but let's go to this week. The 13th dropped to $1.28. Now it's down to 86 cents. Let's take this date, March 13th, Tuesday, 3 days ago. Let's call it, well, okay, let's call it 83 cents. So it's a 17% loss, but if we stayed in and didn't close out because we stayed to our trading plan, we still have a loss here. What likely could I have done? Well, what I would have done in this case, I can't sell a call against this. Maybe I could. Okay, maybe I could hedge the loss a little bit. One of the first things I could do, since I still have 3 days left, I could sell the 62 call at 53 cents. I'm running out of time. I've only got 3 days left. I'm not right at expiration, Ruth, but I've got 3 days left. And there's some good premium here at the 62 call. Oh, no, it's not. No, it's not. Wow. I'm sorry, folks. That jumped on me. It jumped to the wrong expiration. I'm so sorry. We're at a 70% loss here. So, okay, I could still sell this and hedge it. My apologies there. But at this point, the March 16th is well below where we need it to. Let's go back to March 12th on Monday. March 16th expiration. The 61's at 92.97. If I haven't closed yet, I'm running out of time here and I'm still at a loss in the position, but it's a small loss. 4 days left. Looking at a small loss. I might have managed here, but to tell you the truth, Ruth, sorry, I probably would have waited an extra day hoping for the stock to go up, but now I'm panicking. So here we are. Let's stick with the 13th. 36 cents. I'm at a huge loss. Lost that $1.28. I thought it was coming back. It was only at a 3% loss, 3 days to expiration. Now I'm in trouble. I could sell the 62 call against it to sort of create a bull call debit spread for 15 cents. That's not really going to hedge my position. I could take the chance and sell this call to create a bear call credit spread and get about 70 cents at the 60 strike. That would have hedged some of the loss. Okay? Actually, it would have looked pretty good today. But it depends on where you think you want to go. So the 61, let me write this down at 35. Okay. And this one here. Now, this isn't what you're asking, Ruth. I know. I'm getting to that in a moment. But here's our position that we opened on March 6th. Went against us. Let's say we didn't close it, even though everyone who answered that poll would have closed this position within the first 3 days. But we stayed in. Here we are March 13th, 3 days to expiration. The stock's pulling back. I've got the 61 call. The stock's below 60 now. I'm in a panic. On Tuesday, I could have sold the March 60 call to create a bear call spread because the stock's going against me. And we could have sold this for 68 cents or so, 65 cents. Let's just put in 68 cents, okay? But you see the problem. This is a credit spread not done at a credit. It's going to be a debit of 34 cents. And remember, at this time right now, we're losing 70%. We've lost 70 cents on those positions. Okay? So, this spread we're creating, instead of losing 70 cents, could guarantee that we're only losing 32. Not ideal, not what we want, but it cuts into the loss. But with the stock remaining below 60, you took a chance. Both options expire worthless. You take a loss of 32 cents instead of the full loss today. You tried to use hedging a little bit in your time. Now, if you're afraid the stock was going to rebound and move back up in the next 3 days or the next 2 days, sure, I could have tried that bull call debit. I don't think it would have worked, and it looks terrible right now, but you would have hedged the loss a little bit. But we could have sold the 62 call. We saw it for about 16 cents, didn't we, on that day, on Tuesday. So now I can only lose 85 or 84 cents. But if the stock recovered and moved back up to 62, well, because of the cost and the capped gain at the 62, you're only making 15 cents, where you'd still be at the dollar cost for that position. A more likely alternative, Ruth, at this point, I'm losing on my long call. It's going to go to zero, or we've got 30 cents. I could close it and take the loss. What I most likely would have done if I think Amrit's going to recover, we don't know. I don't know. But I'd sell to close that 61 call for 35 cents. And then I'm going to go give myself more time. Not maybe even further than April. I might even go to July. Okay? But I probably want to be somewhere in this range. I don't want to go too deep in the money. I don't want to speculate and go too deep out of the money. 60 is a reasonable target right now. It's at the money, but it has the most time value. I might go with the 57.5. And there's a reason why I'm going to July, and there's a reason why I'm going to the 57.5. So let's call this 630. Okay? So going back to the custom spread tool now, we're going to sell our 61 call at 35 cents, taking a loss of 65 cents. I kept saying 70. I'm sorry. We're going to take a loss of 65 cents, 65% loss in the position. And I'm going to buy the July 57.5 call. And I'm sorry, we did this on Tuesday, so it would have been 630, maybe 627, but we'll just go 630 to keep the math simple. All right. What am I looking at here? Well, in reality, what I'm looking at is I now own a July 57.5 call for $6.95, incorporating the 65-cent loss I took on this position, or 65%. Okay, so let's make our graph look perfect. Let's clear this out, factoring in the loss from the initial position at $6.95. Okay. All right, so 1 second here. So now, whoa, sorry folks, there we go. Got a lot of questions coming in here. I just want to make sure. Okay. 1 second, 1 second, 1 second. I apologize. Wanted to check this one here. Okay, you said not 22.62. Okay. All right, sorry. Okay, so now you're just in a long call, but with a higher cost basis. 7 times what you originally had on the position. Okay? But I'm out to July. I'm at a 57.5 strike, which is about 2 points in the money. That's kind of decent. But now that I know the movement, let's go out 13, 14 days. The 60 call at 111. Let's go with this. Well, that's tempting, but the stock's right there. So I'm going to go out of the money again. But now instead of buying this, maybe I sell this. Okay? I'm going to create a calendar spread. I'm going to start cutting into this price, get back the 65 cents that I've lost with a diagonal spread. Now, even if the stock does make it to 61, based on the value, theoretical value of the long call remaining, and what I still have available for the premium I generated, this could actually be a profit if the stock goes to 61 in the next 14 days, if I'm still bullish. Now, if you still think it's going to recover much more than that in the next 10 or 14 days, you can just leave that long call open. But now, yes, you have 7 times what you invested into the original position. You can roll it out to try to repair it, but you still have to be bullish on the position. Selling this call now creates a diagonal spread, Some people might call it the poor man's covered call. I'm simulating stock ownership of this, but as you can see, in a covered call, I only risk 100% if the stock goes bankrupt. In the diagonal spread, I'm risking 100% if the stock starts to drop maybe down to 50, 50, or 47, where this stock was a few months ago, by the way. It was down to that $48, $49 range and then had a nice 1 month run. Then February 2nd and 5th hit, and then it came back up again, okay? But now you can see in 14 days, you might actually be at a small profit instead of taking the full dollar loss, instead of taking the full loss, or instead of thinking that you're risking the full $6.95. That can occur if the stock falls, but if you're still neutral to bullish, this is a way to go. And if the reverse was true, if you were in a covered call to begin with, or a spread, of course, if you had bought the stock and you had, I apologize, sold the call against it, and the stock moved down and you're at a loss, of course, you can buy back your short-term call or let it expire and then roll that call out into a lower strike price as well. So Ruth, normally what I would do is go further out in time with my long calls. Not to be short-term, not hold them all the way to expiration. In fact, if I buy a call that's 4 or 5 months out in time, or even 3 months out in time, I'm closing or adjusting that long call when I'm within 30 to 45 days of expiration. So I don't lose all of the time frame. If it's not doing what I want to get something back. If I had bought a March 16th call in December and it wasn't doing what I wanted by February, or when February 2nd and 5th and 6th hit with that volatility collapse, I might have adjusted it at that point, rolled it out to maybe a July, or rolled it out to maybe an August to give myself more time and to readjust the position. But you're going to increase your cost basis because you got to pay for more time value. You have to factor in the loss of the original. You may want to convert it to a different position now to try to take advantage of your sentiment going forward. Okay? All right, so that's what I want. I'm just going to the bottom here real quick. Everyone, just hold on. All right, so there's a lot more questions that came in. I'll get there. Now, Sam offered something else. He said if the market's going against you on your original position, that 61 call that we had, and it was moving against you, he says you can buy a put 3 to 4 weeks out to hedge the position, maybe at 57. So now that you were in a long call, it wasn't doing what you want, the stock started to fall, you're losing money, Sam suggests you could buy a put to hedge it. Of course, when the stock jumped up to 61.61, that would have been the best time to do that as well, but we didn't see that at that time. Now, Ruth, one other thing I wanted to mention to you, and I knew I'd reference it, at any time, later this weekend if you have the time, check out the webinars page. You can access it under free webinars under the main home. It is also a public page. So I'm going to go here, sending it in the chat window to everyone, powerup.com/webinars.asp. Okay? And if you go to options strategies, there's discussion here on managing your spread positions, how to be successful with spread trades, and so forth. A little bit further down, I think from August and July, there's a full webinar here, July 21st, 2015, I'm sorry, it's 2 years ago. But it's the same webinar I teach today on it, but it's a full discussion on management techniques for long calls and long puts when the underlying security moves against you. Managing the position if the option is profitable to take out the risk, or if the underlying is stagnated and you're losing time value as well. So you might want to take a look at that full presentation on managing the long calls there, in addition to what we sort of discussed today. The short answer to your question is, with examples, yes, you can roll out at any time. And you can adjust it that way, but you still have to have a sentiment going forward. Can you adjust it to lower the risk? Well, you might be able to adjust it further out in time, but as I showed, that's always going to increase the risk in that position because you're paying into more time value, but you can use hedges such as selling a call against it to create a diagonal, or maybe even a vertical spread, the bull put or the bull call I showed with a shorter term, but both of those didn't work out because you were too close to expiration. But if you roll it out, you could convert it to a vertical as well, depending on if it matches your goals. All right. Next question. I'm just going to go in order of the questions that came in. Okay, Sam has a 280 put on SPY last week, 4 weeks to expiration. So he's holding a 280 put on SPY. As you saw, my VIX calls, Sam's, are essentially worthless, so I'm going to have to figure out how to roll those VIX calls. It was briefly shown in the portfolio here. I'll go back to it. But sometimes using a market hedge, back on February 19th, I had bought 2 March 25 VIX calls as a market hedge, and I'm losing on this, but the VIX hedge is more than profitable in 2018 simply because of what happened in February 2nd to February 9th, February 5th to February 9th, excuse me. But these are coming up to expiration, as you can tell, next Wednesday. So I'm going to have to go, as you said, 3 to 4 weeks out, buy another 2 or 3 calls, factoring in the dollar loss I took on this one, or 89, 90%. Amrit asked, is call selling or put selling more profitable now for Amazon or BKNG? It's really simple to see, okay? In the sense that I can go to the chain very easily, and if you wanted to look 1 week out, let's go to March 23rd, we're at 1571.68 for Amazon, right? So we are now having a direct even one, but it's pretty close here. Let me just pull up the calculator and you can watch me do this as well as I'm going through it. Okay, well, so the call option, at the money call option, 1 week out, 1960 to 2110, so we're looking at a $1.50 bid-ask spread. Let's say we get midpoint at 75 cents, so that'd be 20.35, okay? So the call premium, at the money, 1 week out, 20.35. But we are a $1.68 in the money, okay? So the premium, the time premium only, true profit of an option seller is $18.67. The put, oh, they don't make that very easy, do they? The $15.70 at the money put, bid of 17, ask of 21, $4 spread. Midpoint would be 19. It's out of the money, so that's all time value. So it's about 33 cents higher, okay, on Amazon. So just based on that alone, I could say, using the at-the-money options, that's better premium. Okay, what if you wanted to sell an out-of-the-money naked call? Well, let's go 20 points out of the money to 1590. Again, premium of 10, ask of 1180, midpoint of 1090, 20 points out of the money. Not that much, I know, percentage-wise. But now let's go to the 1550. 905 to 12, let's call it 3 points, so that would be 1050. All right, so when you go out of the money because you want a better probability of expiring worthless, right, this was midpoint of, I'm sorry, 1050, okay, and the 1590, so it was 20 points up and 20 points down. Yeah, I'm sorry, 20 points up and 20 points down. So 1050 here and our midpoint of 1090 here. So 20 points out of the money, the call is more expensive. Okay, so which is more profitable? Well, I don't have that answer because I have no clue what Amazon's going to do in the next 7 days, 10 days, 12 days, 15 days. Okay, you can look at a chart and say, well, it's come off the Bollinger Band. It's still, MACD looks negative, so this looks like it's going to drop. So maybe the call's better. Or it could continue this lovely pattern on the MACD where it's going above and below and above and below, going up and then back up and then back up. So it could go this way where the put would be better and not have to worry about buying it back. I don't analyze individual stocks, okay? I'm not an advisor. What I just showed you is what is the premium that's available for Amazon, and if you go at the money, which I would never sell a naked call or naked put right at the money, even though that has the best time value, because you've only got a 50% probability of success, right? So that's the answer. The answer is there is no answer. You've got to pick the trend that you think is available and go with that. If you're bearish, you're selling a naked call. Not something I do. If you're bullish, you're selling a cash secured naked put. Or you're selling the naked put on leverage. Or you're doing an out of the money strangle. not straddle. Don't do straddle. An out-of-the-money strangle where you're selling the 1590 call and selling the 1590 put, or 1550 put, excuse me, and then you'd have to figure out your margin requirements if worth it. And you can do the same thing with BKNG. I'm not going to go through the whole thing with it here, but when you're asking what's better, what's more profitable, I don't know. I can look at that chart and see it moving up with little pullbacks on Amazon and say it looks like naked puts or selling puts would have been more profitable, not based on price, but based on performance. BKNG, let's just, again, it's $1.40, 217.149, so $1.49 in the money. You know, the 2170 call was at $2, so let's say $23.20, but then we have to subtract the $1.49 from that. Let's just call it $1.50 because it's $1.50 in the money. So we're looking at $21.70 would be the time premium of the at-the-money call on BKNG. The at-the-money put, $1.60 bid-ask spread, let's add 80, $22.10. So in this case too, the at-the-money put is 40 cents higher. But what is the chart? What would have been more successful over the last 3 or 4 weeks if you were selling a weekly call or a weekly put? Obviously, selling the weekly puts would have been more profitable if you started here. Even if you started here, selling weekly puts would have been better because if you sold out of the money weekly calls, you're probably adjusting here, then adjusting again here, and you're rolling it to get out of the way of the train. This has a more pronounced MACD signal than we saw before, but it is starting to ebb. So again, can't predict, but we can look at the prices on the chain and you can evaluate based on how far you'd want to go out of time, probability, or with delta, for example, which one would give you the best return, or which one's more profitable to sell. It's got to come down to what you're looking at there as well, okay? All right, just scrolling down here at the bottom, and Sam popped in, and he does say the buy to sell ratio on the stocks is showing negative signs this week. One must hedge their positions. Okay, so other things you might want to consider is looking at things such as the put-call open interest ratio, put-call volume ratio. Sam's talking about different buy-sell indicators as well. But which one's more expensive? It depends what you look. BKNG and Amazon, we see the at-the-money. If you're looking at just the at-the-money, the puts looked a little bit more profitable. Money. Success-wise, both of them seem to be trending upwards, although Amazon was showing a little bit more of a pullback with the MACD. And then Sam, of course, mentioned looking at the buy-sell signals also. All right, we have a question now from Isaac. He says, Michael, there is so much optimism about the outlook for Micron. I took a look at option price for the out-of-the-monies calls, I guess, as high as 90. Price of the call expensive is for 19 and 20. Discuss the cheapest way to bet on a bullish outlook for deep out-of-the-money calls. Well, going to agree with you on this one in the sense that, again, if I'm buying calls, especially out of the money, speculating on a market movement, which really does not have a good probability of success long term. Let me hold January, October, let me hold October, and I'll go to June or July. I'll go July, 126 days out. Okay, so I mean, the out of the money here, 560 to 595 to July expiration. At the 65, the 62.5 is 660 to 7. And then there you are at 1065, $10 at the 65 for the out of the money. I'm only looking at the small chain. We'll go to medium chain. That's a bit much, and the 70 is really high as well. Micron's a fun one. It goes all over the place, and that's important to note. So here it looks it's been stable, and then it's moved up, had a Bollinger Band breakout, showing good strength as well. Okay, so what is the best way to play it? The cheapest way to play it? Well, you got to pay for what you're looking for. If you want more time for the option to move in your direction, yeah, you're going to be buying out of the money. Anytime you go further out of the money, I want to be cheaper. I want to pay $5 per contract by going to 75 here out to October, around $5 per contract. I'm 15 points out of the money. Very little rate of success here unless the same pattern that we've seen in the last 30 days continues for the next 30 and then the next 30 after that. All right, you get what you pay for, in all honesty. We looked last week at something that didn't work out. Okay, last week someone wanted to mimic more of a married put or use a lower cost by trying to generate premium. So rather than buy, we'll keep with that October OTM call. Oops, sorry, that would help, wouldn't it? Let's put in a symbol, MU. Let's go to October. And we saw the 75 call. Let's call it a price of 5 points. Okay, now that's not that bad, but you're not going to get much cheaper. That if you go to the 90, I mean, think about it. You're expecting a 9. What would the 90 be? That'd be a 50% increase in this stock in the next couple of months to get a good profit. Now, you could get more profit sooner than that, of course, too. But again, we're looking at the halfway point here, the curved line, break even at about 69 on July 4th. Okay. What someone wanted to look at last week was paying for this by selling a out of the money put, either closer in or same expiration. Okay, so we'll go closer in. We're going to hedge this by half by selling that 57.5 put. Okay. So now what have you got? You've got a long call. You're generating some premium against it. You still have a limited upside, but that long call does not cover the obligation of the short put, meaning you could still end up buying shares of stock at 57.50. So you've got to cover this margin requirement. That's going in the opposite direction of what you want. So then the idea was, well, to hedge that, let's take our April 20th. We sold a 57.5. Let's buy a 55. Okay, well now we're taking $1.86 and we're only collecting $1 or less than $1 against the position. What did we do? Now I have a bull put spread for April 20th with the 57.50 sold, 55 bought right here. Credit of about 90 cents to hedge the cost of the $5 long call. Does it change the dynamic of the spread? Well, if you're bullish and it stays up, both puts expire worthless and your cost basis is lowered to 410. Okay, so that's one way to do it, is to do out of the money bull put spreads over the term of that out of the money long option to kind of hedge it. What's the risk? Well, if the stock falls, 54, 53, drops back down, you lose the 250 on the spread, probably most of this well. Let's take a look. What would happen at April 20th? If our stock fell down to 53 below both strike prices, unexpected market event, who knows? Something happens between now and April expiration. You're at about 100% loss of what you would have paid for the long call. The long call would drop to a theoretical value of about $2. You did collect income to hedge that, but now you've got to cover the 250 loss of the bull put spread. Okay. Now there's other hedges that you can do, but honestly, if you think of going out of the money, I think it's too far out of the money at the 75, but if you think going that far out in time and going out of the money and you think $5 is too expensive, again, you get what you pay for. You're not going to find cheaper than that going that far out in time to give yourself enough time. You want to pay a cheaper price? Let's keep that bull put in mind. Let's go to the research tool very quickly. Oh, no. No. Okay. I'm not selling the April bull put because earnings are coming up on 3/22. If it has poor earnings, because it's been on that run, if it has an expectedly poor earnings and it drops back down, which easily it could do, 10% would put it at 54. I've lost on my April 22 bull put, 250 minus the 90-cent net credit. So we take a 160 loss, and my long call is dropped. So I'm in trouble. I need a lot of gumption going forward to do that. Okay. All right. Sam says he likes the bull put idea in the bullish stock, but if the stock drops, it's easy to manage as well. And looking at the chart, I agree with you. When we looked at that chart for MU, I said, yeah, this does look really bullish. But with earnings coming up in 7 to 10 days, I'm almost tempted. It's a balance. I might be tempted to do a cheap short-term long straddle on this position, and it's not going to be that cheap. What do I mean by that? We saw that the earnings are coming out at 322 after market. It's confirmed. So at this point, what do we know? The stock might swing one direction or the other or not move. 23rd is probably close, but right now, oh wow, that's expensive. There's your $500 right there for the straddle. I don't think that's necessarily a good idea. Okay, Sam's in this stock, of course, has gains on it, and he's puts on it as well. So that's what we're kind of looking for also here. But yeah, if I did a straddle on this, it's more expensive than that out of the money long call. I'm paying $560, so I need a 5-point movement one direction or the other to break even on the 22nd. And that's, if you go with the 23rd, the minute you do that and the earnings come out in the morning on the 23rd, these are both going to go to intrinsic. One's going to go to zero, one's going to go to intrinsic. That's going to be a hard one to profit on. And going further out, you're paying a little bit more, but at least you have another week to go. So everything's already factored into MU with those prices. Okay. Long collar, Sam says the RSI is way up above 80. Rajiv says that yes, for a bullish stock like MU, a long collar helps. It's expensive, but you've got controlled risk. Okay. And what he means by that is if I bought the stock today, 100 shares, went through the 23rd, sold a nice premium out of the money to give me some growth, bought a cheap out of the money put about half the price or maybe a little bit more. So I'm selling the call like a covered call. I'm going to buy the put with earnings. Most I can lose is 4.4%. I could make 4% if the stock gaps up or choose to close the call, stay in the stock after the earnings, and then buy a further output as well. And Sam's stock price is at 50. Yeah, so Sam, with the stock now at 60.58, he probably bought 62. Oh, he bought 62 puts, so he's locked into a strong gain on that position as well. Sam H says, in the search section, okay, so those are some of the ideas. Synthetics don't really work because you still got to pay for that longer term option there. And you're, oh, sorry, folks, you're going to have to buy that longer term option, and it was expensive on MU because of the movement. Are there cheaper alternatives where you can try to do the selling of the put to get some income to pay for that? But remember, long call does not cover the obligation of the naked put. You still may get put the stock. So you're going to have to cover that. A way to avoid covering that is doing the bull put. But now if you're wrong and the stock drops, you lose on the long call and on the bull put, increasing your risk, even though you generated a premium up front to begin with. All right, so Sam H. Sam L's been the one commenting before. Sam H's new comment, in the search section, is there a way to search for the best setups on near weekly options? Yes and no, okay? If you go to covered call or naked put, Ernie created the weekly picks of the day, did exhaustive testing to come up with the best criteria that worked over a 1 and a 3-year and a 5-year period, okay? And that's what's available. I click on weekly peaks of the day. It shows me the ones that match here, but they're only updated at 3 o'clock. In the search for naked puts or for covered calls, you can see the weekly picks of the day. Instead of just seeing the top 3, which Ernie selected based on his trading plan for the picks of the day, you could see the full list and sort of maybe enhance it by putting in some criteria. Are these the highest return ones? No. Are they the best ones? They're the best in the sense of exhaustive testing of different stock fundamental technical criteria, range out of the money, avoiding earnings between now and expiration versus not, premiums to look for, range out of the money. This set of criteria outperformed probably 50 to 60 other iterations of different criteria and tweaking the knobs to get the best 1-year and 3-year results when Ernie did his testing. Okay, covered calls, same thing. You can see it in the search there, and these are 7 days out. If you go to bull put credit and you go to search, there's a default search in there called weekly bull put spreads. This is what I do in my portfolio, but these are all 13 days out in time, 14 days out in time. Why? Because when I ran these tests, the same exact stock criteria, looking for stocks with a certain MACD cross, range above the 20-day moving average, avoiding earnings, other basic criteria there, and looking at minimum net credit, minimum return as well, range out of the money 3%. When I took the same criteria and lowered the net credit slightly to 15 cents, maybe a little bit less, and lowered the range out of the money and looked 1 week out in time, same exact stocks were in the list. The 1 week out spreads over the course of a 1 and 3 year period, or over the 1 year period, first 1 year period, 2016 to 2017, no, I'm sorry, 2015 and 2016, the options that were 1 week out on the spreads were negative. Same criteria going 2 weeks out, giving you more premium, a little bit better range out of the money on the short put, was double-digit positive, 45, 46% return over 1 year. Now, over the 3 year period, the 1 week out was profitable, but only about half of the profit that was seen going 2 weeks out. Every time Ernie and I have run a test on credit spreads using criteria that work, what we find is going 2 weeks out always outperforms the 1 week out test. Okay. Also, what's interesting, spreads that have a strike difference greater than $2 or equal, spread difference of $2 or more, whether you're 1 week out, 2 weeks out, or somewhere in between, always have outperformed every test we've run. The same search criteria, again, whether it's 1 week out or 2 weeks out, 2-point spreads or higher, the returns always outperform spreads that are 1 strike apart or less. It's because they get violated for the full loss too quickly. Once it starts to move against you, starts hitting a short put, a little movement upwards, you're at the full 100% loss. Whereas in the 2-point spread, you might only be at a 25 or 30% loss. So it's kind of interesting, those things we found out. So we've put these together based on what we do, what we found works best in our personal accounts. You might go to, there's a search for iron condors. I haven't tested that one recently, but other strategies, you may go into long call or long put and say, wait a minute, I went into the long call search, Mike, and I didn't see a criteria for buying weekly long calls. And honestly, it's because we've never found something that's consistently profitable buying 7-day out calls on those positions. Buying 1 week out calls or buying 1 week out puts, we've not found something that's consistently profitable, believe it or not, with all the market conditions. Let's go back to a chart here. I'm going to go maybe a year, and I'm just going to look at SPY. Now, I know it's exacerbated a little bit. I should just go back 6 months to illustrate this if I can. Let's go back 6 months, and I'm going to increase the size of the chart too for you. Hopefully that gives us a little bit better view. Large. Hopefully I don't need to go big. Let's try large. All right. So you'd say here, how can you not profit with weekly long calls over this time frame? And this is from September, essentially here. Well, remember, the beginning of September, there's a little blip. Not enough, but it would have cost that first week, the beginning of September, all of the weekly long calls you entered at the beginning of the month would have lost money. And almost all 100%. Okay, so now you've got to make that back. And then you see, this looks small, but it's significant, right? It's about a 257 to a 253 drop. Oh, maybe not 250. A 257 to a 254 drop. That's tough. That's a little one. Here's the other one. Here's this other one. Okay? At the beginning of each month, with the exception of January, but in August and September, not much one of in October, it happened later, but in August and September, in November, in December, there were events that caused sort of a 3 to 4%, 5% drop across the market. So buying weekly calls, you're taking 90 to 100% loss on these this week, 90 to 100% on this week, 90 to 100% this week, 90 to 100% this week, and the lie of leverage starts to catch up with you. Now, these small gains you're making here have to counter all you lost here and here. And this probably took maybe care of these two. But then you hit another one. So now this has to take care of this. Now this, you probably would have been good, and then you just would have gotten slaughtered. And then you could have made some of it back and then gotten slaughtered. These are all near 90 to 100% losses using weekly calls. All right. So Sam's approach, I don't think he commented on this yet. I haven't scrolled down to the bottom of all the questions. But with this approach here, weekly long calls, sure, you can see good returns, and you would have had a great month here. You would have given it all back here, plus whatever you made here. And then had some good gains here. You gave it all back. You might be ahead slightly here using weekly long calls. I might have to test that for you on SPY. We'll try weekly longs. So I'm going to go August 1 to today. All right, I might have to run that test next week and see. But you might only be ahead by 10 or 12%. That's good, but long calls, you're expecting much more, okay? Yeah, and since this drop, Sam says he's been doing covered calls on SPY. Good, okay. All right, and he still has those puts, the spread he mentioned earlier as well. All right, so, let me go down to Michael's question. I have a long question from Will. Michael's question was related to this, I do believe. Okay, I'm sorry, it was back to what I was talking about on the 2-week spreads. Here? Nope. Sorry. Of course, I take bull puts out. Anyway, Michael, your question was, on the 2-week out credit spread, do you close after 1 week or do you hold to expiration? Hold to expiration. And no stops. See, when you go to the naked put weekly picks of the day screen, you can click on this view that says, see how we develop these results. This will walk you through the thought process of what Ernie did. I've got this updated from January 1st, 2015 to January 2018. They were supposed to be updated this week. I'll get them updated later for the returns for the weekly covered calls, monthly covered calls, weekly naked puts, and so forth. But he walks through his thought process, including where he set his stop. On the bull put credit spread testing that I did, that will also be posted soon, when I did the weekly bull puts that were 2 weeks out, any stop I used hurt the results so much that it moved almost triple-digit profits to a loss. And I'm talking reasonable stops. If the stock drops below 1% of the short put strike price, close the spread. If the stock reaches within 1% of the short put strike price, close the spread. And what I found out is because of the criteria that I was using, and I was sorting by the highest probability, so I was looking for lower return spreads, we had a 93% success rate over a 3-year period in about 156, 157 trades, okay? Meaning that 93% of the trades expired worthless. Anytime I tried to put in a stop, you only lowered the results or actually turned them negative. So yes, I hold them all the way to the 2-week expiration and look for them to expire worthless. Of course, that's what you want anyway, but yeah, look for them to expire worthless, Michael. That's what we have there. Okay. All right, Isaac, there's your question. Oh, no, I'm sorry, Isaac. We were talking about MU. That was the question we answered regarding to MU and the optimism and trying to lower the cost, okay? And Sam says, what do you think about Twitter? I've been trading from $21. I own stocks. Doing iron condors plus protective puts and a collar strategy is a good stock to learn various strategies. Yeah, I'd say that one, and one of the ones we were just looking at earlier as well is that the Amrit is a good one to learn different strategies, okay? So that's kind of the idea there. So MU had offered some good movement, and Sam, of course, mentioned that he's in MU as well, and he bought those 62 puts and trading that also. All right. Will, I know you asked your question, but that's how fast the questions come in, Will. But I know you asked your question at the beginning of the webinar. That's how they come in. So Will says, I am an owner of the blueprint, the guide for the radioactive trading married put technique. He says, I understand it is possible to start from a married put into a conversion for riskless profit. When I see a condition on the market that has conversion right from the start, why can I not get a fill? For example, Microsoft, MSFT, has a call that has more extrinsic value than the corresponding put. However, when I enter the 3 trades for a collar, what's called a conversion, a same strike collar, I cannot get the fill even though the underlying is liquid and the conversion existed for over an hour. When I try to implement the trade one leg at a time, the condition quickly goes away. That's right. Just wondering if the market maker is trying to prevent some people from entering into conversion trades. Conversion trades are tough. What is a conversion? Well, I thought this was a blueprint question, but I had to read all through it, Will, so I apologize for that, and that's quite all right. Why can't you get a fill? Yeah, I got that. Okay. Conversions are very tough. I have a conversion search for you in the long collar. I don't know if that's how you found it. What is a conversion? A conversion is a standard collar, meaning I'm going to buy stock, sell an at or just out of the money call, buy an at or out of the money put. I'm sorry, phrase that. Sell an at or just out of the money call, maybe slightly in the money, and buy the same strike put for the same expiration, looking for a net premium that counters the intrinsic loss I'm giving up. The first example that comes up, Walmart, 89.17. Sell to open the 87.5 call at 335, buy the 87.5 put at 110. Get a premium of 225, okay? Now, I'm looking, either way what's going to happen is I'm guaranteed to get 87.5 back from this position, no matter what happens in April. Stock was 89.17, but we've taken a premium of 225, which means my cost. I'm sorry, if I get 87.50 back, the cost comes out to a guaranteed profit of $66. So the total in is 86.83, and in theory, we're guaranteed to get 87.5 back. This means that between now and the 20th of April, if the stock falls below 87.50, let me just get this to expiration. I hate the midpoint profit and loss chart on these positions. Let's just go right to expiration. All right, there we go. All right, it's a straight line profit and loss chart. Why? If the stock falls anywhere below 87.5, what happens? The call expires worthless. We exercise the put to get back 87.50. The stock rises above 87.50, what happens? The put expires worthless. We get assigned on the covered call, essentially at 87.50, and make the $66 of profit. Okay. Now, when we looked at the search, interesting, wasn't it? There was about 3 or 4 positions at the top of the screen that were all Walmart. Okay. Walmart here, 5, top 5. And then we've got some SPYs that show up as collars. They're very, it's very small returns here, 0.2% as we go further down. Okay. Why are we seeing so many Walmarts? I haven't looked yet, but I bet you it's because it has earnings coming up sometime right before the 20th or within the next few days. Why aren't you getting filled? Let's take a look. Now that's not too bad. And we showed the natural bid. Oh, this one grabbed the midpoint. So let's say I got the natural at 335 and at 110. Okay, so that's the 225. It's going to be a much smaller conversion in this case. 0.7% guaranteed profit if you got filled. So why are you not getting filled? It's very difficult to get filled on these conversions. Is the market maker maybe watching it and forcing you to go 110 here or maybe 111 and forcing you maybe to try to get 334, thinking it's okay if I get 334 if I pay 111 because I'm still within the range for the conversion? And during the day, it's very hard because the stock's moving 10 or 15 cents up or down, which could negate 4 or 5 cents on either position, and then you're out. It's very, you're out of the conversion. It's very difficult to do. And although this looks attractive as a guaranteed profit for 30 to 60 days out in time, 35 days out to April expiration, if you're looking weekly and you find when the guaranteed profit is only 0.1%, meaning you're fighting as you're trying to enter the trade 1 and 2 cent movement of the stocks, which might be raising or lowering the bid or ask of the call or the put by 1 cent or lowering it by 2 cents. Oh, it's so hard to get. They really are. Only gentlemen I know that I've talked to that I can recall in the past 10, 15 years, I've been with PowerOptions since 2001, 2002. The only gentleman I know, he does a lot of these conversions, but he does them always about a year out in time. He's going to January 2019, things of that as well. And so that's a little bit difficult to do. and he usually ends up legging into it. He'll open the covered call first, and when he sees a pullback, he'll buy a lower strike put or vice versa to get into the position. Let me go to stock research here. Wow, that's interesting. Walmart doesn't have earnings until 5/17. I was surprised that those Aprils were as priced where they were. In that case, you weren't getting filled. Even though it was an in-the-money call, remember, the 57.5 was in the money, the 89's right at the money. Natural should still give you a good premium of 65 cents or a 0.5% return. Something's recent news I probably didn't see today doing that as well. Okay, so yeah, conversions are tough, and they're tough to get filled on. And remember, if you're only seeing a 0.1 or a 0.2% return, if you're only trading a couple hundred shares, you've got to start factoring in the commission costs, because that'll come into play too. Okay, so I don't have a direct answer for you. Is the market maker possibly watching it so when he sees a stock fill or when he sees a call fill that he's not allowing one to go with the natural? Possibly. I don't like to go through the conspiracy theories in that sense. Of course, that being said, every time I do a covered call or sell a call on my married puts, I know the stock's going to move up 6% in 2 days because it just has to get me into trouble. And of course, if I roll a put down there to try to get some lower cost, I know the stock's going to drop on me. So that's just the way it goes. But conversions are a tough way to be successful in trading. I only know the one gentleman that does it. He does far out ones. He doesn't do near-term ones at all. And if you're doing shorter term, remember 0.1% is a reasonable premium to expect on a weekly call or weekly conversion with the low premiums. Then the commissions come into play as well. Oh, simple question from Jerry, and it's not simple, okay, but it is relatively simple. Jerry says, if you own a dividend-paying stock and it pays into your account, how do you enter that cash in your portfolio? He also says, what if you also have a dividend stock where the dividend is reinvested into the stock position? Okay. I don't have anything entered into these, so I'll just start here. Ignore the title of it, I'll just start here. And doesn't matter, I'll just put in a long stock here. Sorry. All right, so I have a position. I have 300 shares of Amrit, let's say, for example. Bought a few days ago at a cost, oh, sorry, not just a few days ago, as we saw, for a cost of, let's call it $59.99. Okay? That was actually on the 6th, but whatever. Okay, so I have a portfolio. I have this position. I get paid a dividend. I don't think Amrit pays a dividend, but for the sake of argument, Amrit pays a dividend. Let's say it pays 35 cents. That's high, I know. Okay, let's call it 25 cents. 25-cent dividend on Amrit. So to add the dividend, I just go to Position Actions and Add Dividend in the portfolio. There's 2 ways to do it. I can do it by total cash amount. So I have 300 shares. I got 25 cents, or $25 times 3. So I get $75 total on my 300 shares. Now this is total cash, so I have to do that math in my head. I made 25 cents, which translates, $25. Okay, and it's on 300 shares. So I'd get 75 total and put in today's date. Now watch me do it wrong. But you can do it by this amount, the total cash amount. Okay, so that's right. What happened? Notice my effective cost per share has dropped 25 cents on the listing. But the total cash amount of the position cost stayed the same, but the total market value on this dropped also by $75 from where it was. Okay, so that's how you enter the dividend by total cash amount. You of course have to know, based on how many shares you have and the premium, you got $25, 25-cent dividend times 300 shares, 75. Or just simply use the per share amount. Much simpler. I'm getting another dividend today, or let me put it in from yesterday. Special dividend, $3.15, got 25 cents for 300 shares. Now it's down to $59.49. Why? Because I got another 25 cents on the dividend payment. Okay, now I have received 2 dividends of 75 cents. or roughly $150 total. My portfolio is reinvesting it into long stock positions. Okay, so I technically now, let's say 3 shares. And it's not quite 3 shares because we're at about 60, which would be 180, but let's say I got 3 more shares of stock. I'm not going to put it into this. Okay, what I might do first is add the $180 into the cash on hand basis, Jerry, first, to simulate that I got technically 180, and then I'd put in 3 shares of applied materials separately as a separate long stock position. Okay, why do I want to do that? There's 2 ways to do it. I would do it, there's one way to do it. I'd add in the dividend amount I received into the cash on hand, increase it, and put in 3 shares for a cost of $60. Okay, all right, so now I've got 100 shares and 3 shares. This takes out the 180 I put back into the cash on hand, so now it'd be even. I didn't do that first, which is why it's more negative. Or I could have put in the 3 shares with a cost basis of 0 because it didn't cost me anything. It was just reinvested. But I'm keeping it separate from the 300 block. Why? Because I'm doing other things to this 300 block. I might be selling calls against it, buying puts against it. If this number is odd, so if I have 316 shares and I sell 3 calls against it for a covered call, the system won't read that as a covered call. It wants it to be a 1-to-1 ratio, 300 shares to 3 calls and so forth. If I have 316 shares, it registers it as a custom spread. I lose all the position analysis information and the ability to link to the position analysis screen to see rollout opportunities. Okay, so that's how you enter the dividend. Use the More Information button, go to Position Actions, add dividend, do it by total cash amount or just per share amount for the amount of holdings you have. If you're reinvesting it, you can just put in that you have those new shares at a cost basis of 0, keep them separate, or put in the $180, however much the dividend was, and then put in that you bought the new X amount of shares, but still, Jerry, keep them separate. Okay? All right. Rajiv, I don't know if this is exactly what you're looking for, but your question is, how can we use PowerOp tools to identify stocks with earnings 10 to 30 days whose current implied volatility is much greater than the average implied volatility? Or is it possible to find stocks whose current implied volatility is less than the average with earnings within 15 days? Yeah, you can do all that. The simplest thing to do is to use a long call or a long put. I don't know what strategy you're doing. Very simple process, Rajiv. Clear the filters. Earnings. So I can say between now and 4 weeks from now, there's your 30 days. Okay. Earnings within 10 to 30 days from now, I might just set the earnings to be, between now and expiration, set your expiration time frame 10 to 30 days. Okay. So you can do that earnings multiple ways. Or if you wanted to look for less than 15 days, between now and 2 weeks from now. Simple enough. All right, so that's how you use the earnings one. Now, so your first one. All right, sorry. The first one is earnings within 10 to 30 days. So I want earnings to be between now and expiration. Options expiration 10 to 30 days out. Where current IV is much greater than the average implied volatility. That's the percent implied volatility range. Okay, well, that's how I use it. This is what I use, the percent implied volatility range. I want to look for positions where the implied volatility, current implied volatility of the option is higher than where it has been over the life of the option. So I'm going to put in 100. I want a percent implied volatility range of 100. Okay. I'll try to do one result per security to narrow it down. Okay, there's nothing there. Let me try 99. Okay, there we go. So some of these are close. This is the stock range, not the implied, but there you go. So these are all at 100. These are all at the peak here. You see over here the percent implied volatility range. Wells Fargo, Oracle, GameStop, and the various strikes. Your second process. Is it possible to find stocks whose current IV is less than the average? Okay. So, well, it's not the average, but there's two ways to do this. I could do this 99, and then IV over HV is just the implied volatility of the stock volatility. I might use IV over SIV as the IV over the stock's implied volatility index, the average current implied volatility. I just want it to be greater than 1. Okay, Wells Fargo, Red Hat, Micron, FedEx, Wheaton, Link Motion, don't know them. Carnival, that's interesting. Earnings date 3/22, that's why, 6 days away. Okay. All right, so that's that one. But also current IV, lower percent implied volatility range with earnings 15 days. Yeah, that's the other one. Fundamentals between now and, 2 weeks from now. It's measured in weeks, just now and 2 weeks from now. And then set the IV, HV ratios and the implied volatility ratios where you want. Okay, it's there. Okay. Mike A., you said, I don't know if these are similar thoughts or not, if these are linked to each other. You said that PNR dividend on 4/15/18 is expected to be significantly high. Okay, so at next dividend date 4/12, I don't know if they're releasing a special dividend date. And then you go on to say how to structure the best 1 to 3 risk profit trades. Okay, I don't know if you mean on PNR specifically, Mike. I'm not sure on that. But here's the problem. Again, in that webinars section, I'm going to show it to you quickly here. Go into free webinars and then, again, powerop.com/webinars.asp. We did do a discussion on this, I think, a while back, but there's an old presentation here, really old, on special stock dividends. I'll try to find you the more recent one I did, or blog I did for a customer. I think it was under the blog, but there's special stock dividends. There's no option trade. Well, married put is pretty decent, but there's no option trade that can give you extra benefit of a special one-time dividend. Why? Because money in is equal to money out. What do I mean by that? If I'm in the $70 stock here, we're talking about, let me get rid of some of my tabs, folks. I apologize for that. And let's go back to the option chain. There we go. Oh, it wasn't that. It was a, I'm sorry, it was a PNR. Was it right? My apologies there. Yeah, there we are. Let's call it a $72.75 stock, $72.75, okay? If I bought the 75 call, I wouldn't do that, but let's say I entered a married put. I bought the stock at $72.75 and bought the 75 put 1 or 2 weeks out for a cost of $2. No, it'd have to be $3, okay? And I say I only have a risk of 75 cents, but I'm getting the dividend, that special dividend. So in that case, I'm going to have no loss, okay? Well, I just want to show this again. That's where the special stock dividends is. Well, here's the rub, okay? I don't know if those are the prices, but let's look at it. What happens with a special dividend? And you said it's going to be pretty high. I don't know what high is. Let me go out to April. 75 put, a married put, 290 to 430. We'll just let it grab the midpoint for us, okay? All right, 76.35. So I have a risk of 135, and I have a special dividend of $4 coming out, let's say, on April 13th, before expiration, on 4/13, okay? So you can say, this is fantastic. I'm in a position where I only have a $1.35 risk. I'm going to be bulletproof on the trade. No, you're not. Here's what happens. Let's say the stock and the option does not move. And the stock's still at 72.75 and your put's still at 360. So you're at a cost basis of 76.35 and you have a liquidation of 76.35. When that special dividend is paid, your stock's probably going to drop down to 68.75. And you say, okay, well, that's all right because I'm going to take in $4 of profit from the dividend. At the same time, my 75 put is also going to gain $4 intrinsically. It has to, so it should be priced at $7.60. So, whoops, I'm still at $76.35. But that's not what happens. In a case of a special dividend, this adjusts as well. You no longer have the 75 put. You now have a 71 strike put at $68.75. You're going to get $4 less guaranteed exit. The put options, the call options will adjust as well on that strategy, okay, for a special stock dividend. So that's what we're talking about there in that scenario. The money in the moment before the special dividend is exactly equal to the money out after the dividend is paid, meaning if I have a break even of $76.35, my stock drops 4 points, I get 4 points in. My put strike or my call strike, if you sold a call, is going to adjust as well. After the dividend is paid, my liquidation value would still be $76.35. Okay, so that's kind of the problem there in that scenario. Now, you might be asking something different, okay, meaning that how to structure a ratio spread, 1 to 3 risk profit, or having a 1% risk to 3% profit trades. Collars, going into a long collar position and trying to do an out-of-the-money debit. We talked about this last week. We spent a good amount of time on it trying to structure positions where you're looking to make 3 times more than you're risking on the position beyond doing a long call. That's where the whole idea of doing the ratio spreads came into play, or doing a ratio back spread to have something that looks like this, or that mimicked long call, the synthetic married put, which still ended up being more. And a 1 to 3 ratio is very hard to come by, in my opinion. And let's just keep this. If I was trying to open something on Pentair, a collar that had a 1 to 3 risk-reward ratio, I'll go out to April even, Mike. I'm probably selling an 85 call and buying an 80. Yeah, I'm buying an in-the-money put for about $7 to $8, and I'm selling an 85 call for only 15 cents. Why? Because this gives me a low risk. Well, this one actually came out, if you get midpoint, which is almost impossible. You saw those bid-ask spreads probably due to this. I mean, it's a $4.20 bid-ask spread. I might get $7.10, but I'm probably going to get closer to $6.80 for that, or probably going to get closer to $8 on that price. But if you got filled at midpoint, this might look like a good trade, but you're probably not getting 8 cents here, and there's no way you're getting only $7.10 for this wide bid-ask spread. Let's take a stock that's not as volatile. SNE. It's a volatile stock, Sony, but it's one I'm familiar with. Let me get into the stock again, buy 100 shares, go to April 20th, just keep it simple. Standard expiration, 57.5, 55. 460, good bid-ask spread there, 7 cents, 8 cents there. Oh, I got to sell something, don't I? Call has to be sold. Let's try that. All right, so here's my collar. Looking to make 4.2 for risk of 0.3. But there's only probably a 12 or 15% probability I'll get assigned at 57.5 and make that return. The range here to make it worthwhile, that this is probably where the stock's going to be 75 to 85% of the time, barring any kind of news or anything. Let's make it a little structured. Could I do that better going down 2 strikes? Can I go just at the money with the put at the 50 and maybe go to the 52.5 call? I don't think this one's going to work, all right? And there's no real math formula. It's just playing with numbers. No, this is even. What I'm showing you, Mike, is when you set up a structure on a type of collar, or you could call this, you could do this as an out-of-the-money bull call debit spread. Buying the 50 call and selling the 52.5, and the stock's sort of right between them. This will sort of give you that 1-to-1. In order to get higher than a 1-to-1 risk-reward ratio, by the way, your probability here is only about 30% that you're going to make the 2.7%. Okay, you're probably more likely to get the full 2.2% loss. and be in between and make a profit, that's probably a 50% probability, if you look at it that way. Okay, so I think here the magic number is going to be 52.5, 55, but again, the likelihood of getting that 3 times gain, winning 3 times, or winning twice out of every 3 times, or once out of every 3 times to make it pay for itself, I don't think that's possible. But looks like here it's going to be the 1 strike in the money put to sell the 1 month out of the 1 strike out of the money call. Pretty close, 1 to 3. That's what I'd expect. But again, what is my probability of getting assigned at 55 and making the profit? Let's take a look. Let's go to the research tool for our option here. The 55 call we sold. We're loading the history right now in the background, so it's going to take longer to get to the history here. There we go. All right. My probability, 11.6%. 12% theoretical probability the stock would be above that strike. 88% it's going to be below. Okay, but what about the put here? You know, because if it goes above it, or if it's at 52.99, above 52.50, you might make some profit. But this is the best way to do it. You could try the out-of-the-money bull call debit as well to do that, but I don't think it's going to work. Okay, because I think you're going to take too many 100% losses. How would I do the bull call debit? I'm buying a deep out-of-the-money call, selling a deeper out-of-the-money call for a low premium, gives you a low debit, but it's almost the same risk-reward profile. Percent return looks great, 202 monetary profit based on $48. But man, oh man, remember, there's only a 12% probability you're going to make this. There's probably over a 75% probability you're going to lose that. So can you make it consistent with the stocks you've been selecting and watching over time? Can you make it consistent to do it that way? Okay, I don't know. All right, I don't know. You know, Michael said, the other Michael G from earlier, he says that doing that will get you to the, I'm sorry, doing an Amazon spread is good for the ratio back spreads as well. Okay. All right. Okay, I think I missed something here. Hold on. Okay, let's see. So let me go back up. Okay, sorry. Oh, Sam was just mentioning, I'm sorry, going back through, Sam was mentioning about carbs. CARB is a stock he was looking to sell calls against today. It doesn't offer weeklies, it just offers monthlies as well. Only offers monthlies. I was trying to dissect something here. And you said, how do I find the long option that gives 572% expected return by 415? Okay, that's a tough one. It all depends on the movement. Our tool works opposite. Mike, if I go into the long option finder and I put in PNR, just taking the one you had, we saw it at 72.75. If I expect it to go up to 80 by the 15th, see, the tool doesn't say which option is going to give me a 572% return. It's trying to show you, oh, let me try 5,000. And go to April, which makes sense, sorry. Let's get April 12th, for example. Okay, so here, if this, what this call does shows you what calls would give you the highest return if a stock hit your price on the expected date. Well, you've got to know the expected date, and you've got to know what price. So, but in this case, you would need, for the options there, if you thought it was going to be around 412 or 415, it looks like you're going to have to go up to $84, $85 per share. Maybe it went too high. Yeah, it went too high. $82 per share to see sort of the options that might give that 500% return. That's what the long option finder does, but it doesn't say, hey, what do I need movement in the stock to get a 572% return on a long option? It says, no, I'm expecting this stock to move at this price. Which option is the best one to buy that would give me the highest return? I'm like, I don't understand it. I don't know if I'm reading your comment that you said later. based on your question regarding the 3-to-1 ratios, which would be with deep out-of-the-money bull call debit spreads or bear put debit spreads if you're bearish, or combining it with sort of that deep out-of-the-money collar where the put is in the money to give you that 1-to-3 risk-reward ratio. But I don't think that the percentage win ratio that you would need to make that profitable long-term is going to be on your side. Even though you have a 1-to-3 risk-reward ratio, and even if you structured it differently, trying to use a synthetic or ratio back spread, I don't think the number of times when you would see the 3 times gains would outpace the number of times you took the 1% loss. Just looking at those charts that we looked at, how far out of the money you were as well. Okay. All right. Will had a follow-up question a moment ago here. He says, for regular dividend stocks, sometimes I see the very deep in-the-money put delta has extrinsic value more than the dividend amount. Is it a good idea to go after these for a married put setup to capture the dividend? Without studying, I don't know. Will, I just, without trying to run a test on it, there's no way I could know that. I've never seen it. Yeah, I know what you meant. I'm sorry. I phrased that wrong. You did mean the extrinsic value is less than the dividend. Are those good ones to go after? Well, let's look short term. Let's see something here on Ford real quick. Well, 129. So that's not coming out. 429. That's good. Yeah, it's about there. Last dividend is 28 cents. Let me see what Ford has. There's a 28-cent dividend on Ford coming out on April. So if I bought 100 shares right now, and I want to take advantage of probably May. Yeah, it'd have to be May right now. And the dividend is 28 cents. So the in-the-money delta, so Ford is at, I'm sorry, 12? 11, I'm sorry, so 11.15. So the 14 is roughly 285. $13 is 185. That would work. Okay, sorry. So the 13 put, I don't know if it has a dividend here of that range. But see here, the dividend, the amount, the risk is only 16 cents. Okay, stock's at 11.15. My in-the-money put has a time value of 16 cents or 1.2% shorter term. And the dividend's going to be 28 cents. So I'd have a no-risk trade. But what's going to happen to the stock when the dividend's paid? It might drop down. If it's still trading 11.15, it might drop down to 10.90, right? Well, I've got a 13 put. Stock falls to 10.90. Max risk is $16. So I might make 12 cents for 48 days out in time, right? That's what you're saying. So this intrinsic value, the extrinsic value, excuse me, is only 16 cents, 12 cents lower than the dividend with the in-the-money put option delta of greater than 0.7. So the dividend gets paid, you get the 28 cents, you're only risking 16, so you have 12 cents of profit on investment of 13, 16, 50 over a 45-day, 63-day period. I wasn't in April. I'm sorry. I thought it was, yeah, we're in May. We're 63 days out. So 1% return, roughly 12 cents off an investment of 13.16, okay, 0.8%, 13.18, 13.16. That's your return, about 0.9, 0.8% for 63 days. Does that match your trading goals? I don't know. I just don't know. Okay, so is it a good idea to go after it? Yeah, but you still expect higher movement of the stock, right? You still want to see movement of the stock to get a profit. If the stock falls, you've made, 0.9 or maybe 0.8% from that guaranteed put that was a short period add in time, but are you really achieving your goals? Is that 0.9% you close out of the position later on, you make that 0.8, 0.9% return for 63 days, maybe before 63 days, hopefully, but is that matching your trading goals to be profitable long term? I don't know. You have to answer that for yourself. I don't think that's a good approach long term, even if you find them on a consistent basis, because you're just kind of treading water, all right? And I don't know if it's going to get you to where you want to be. All right, so real quick here, he's been very patient. We lost a couple people, but Amrit again asks, what is the strike of pain? The strike of pain is an old calculation. It's one of the signature tools we show on PowerOptions. Volatility skew, market sentiment, spread chain, long option finder, and strike of pain. Now, before I show it real quick, what is it? Years and years ago, in the 80s, going into the 90s, floor traders started to notice this trend that stocks started to gravitate towards a specific price on expiration day, or just before expiration day, or on expiration day. Okay? And someone noticed they developed the equation called the max pain calculation. Right? We're allowed to use the max pain calculation. They just asked that we call it something differently. So this is the same max pain equation. All right? Now, some people think that the max pain equation, what it's showing you is what's called a pain indicator looking at various strikes on a stock. And a lot of people think it's the stocks with the highest, the options with the highest open interest is the price where the stock will gravitate towards. It's not that simple. Okay, let's take a look at AMAT again. And I'm just going to go 1 week out in time. And we saw it's been bouncing around. What you're seeing here are two things. It's what's called the pain value and the open interest for all available strikes. So at the 35 strike, there's only an open interest of 10. The first question becomes, is that calls or puts? It's both. There's only an open interest of 10 total for calls and puts. And what this tool is doing is saying, if the stock was trading at $35 per share, all of the lower strike calls are in the money. So the 30 call would be in the money. Now, if the 30 call has an open interest of 1, that means $5 in the money, right? $5 intrinsic value on one contract would be $5. Okay, not 500, but $5. But every put here, the 40 strike is 5 points in the money. The 41 is 6 strikes. So $6, $5, $7, $8, and so forth, times that open interest of the in the money puts. What is that monetary value? And then it calculates it together, and the pain value is $12,333,000. Now, the max pain, which is defined as the point where option sellers will make the most money and option buyers will lose the most money, is where that pain value is the lowest. It's not necessarily the highest open interest. See, here's the highest total open interest for both. It's where the moneyness of the in-the-money puts and the in-the-money calls at this point would call the market sellers to make the most and market buyers to lose the most, and that's the strike of pain. And that's believed to be, when the max pain equation was calculated, the likelihood of that price that a stock seemed to gravitate towards on the third Friday of each month. What's the problem? The problem now is that with so many weekly options, so many 50-cent strike differences, dollar strike differences, and more, these numbers changed rapidly, even in a 1 week time frame. On Monday, by the close, this might be back up to 59. Then on Tuesday, it might be down to 56. Thursday, it might be up to 60-50. The numbers change based on how fast the options are changing and the pain value, the new pain value at each price and each new open interest. Two rules about this. How often is it right? I'd say 55% of the time it's in plus or minus 2 to 2.5% range of where the stock's going to end. That is a huge difference, 2% to 2.5%. That is a huge difference if you're trying to sell weekly options and say, well, I think this is accurate, so I'm going to sell the in-the-money 58 naked call and the in-the-money 58 put. When the stock reaches there, both will essentially expire worthless. A 2% difference could take you to a 10, 15, or 20% loss on that approach, okay? I've run tests on this in the past, but the last time I ran this test was well before weekly options were available, well before 5 series in a row of weekly options are available, and I had never seen a 50-cent strike difference before when I had done this, the last test on this. So that's where I'm getting those numbers, that about 55% of the time it's right to within, actually it's more like 1.5 to 2%. Very difficult. It's a pinning tool in a sense, but describing the equation, you can kind of see the issues here about using it. Okay. Another issue with this, don't go more than 2 weeks out in time, or if you just have monthlies, don't go past the next month. The strike of pain loses all credibility when you go beyond 15 to 20 days, all right, because so much is going to change in that 15 to 20 day time period, as far as the range of open interest and the moneyness as well. Okay, so that's a quick overview of the strike of pain tool. It's one of the signature tools. Someone asked us to put it in, a customer asked us to put it in years ago for their analysis. We contacted the max pain equation and moved forward there. Sam says, what's the best way to use the strike of pain? Oh, sorry, I went to the wrong one. I say the best way to use it is to almost check it every day if you're going to use it. I don't use it. We had an investor who said it was reliable BCA software. They developed the max pain. We put it in for the customer. I don't use this. We made it available based on their request. Was a popular term, was popular at one point. I just don't know how more reliable it is. I'd have to run a whole series of other tests on this, and I will do that for you guys when I get the chance, okay? But your question is, how do I use it? Like I said, it's designed to be a pinning tool. If I'm in a position on AMAT right now, let's say I'm in a bull put where I've sold the 58 and I have the 56 and the stock's at 59.44, am I saying, oh, on Monday the strike of pain's 58, I need to roll this? No. I'm still basing my roll on the stock price. If you're looking to open a new position and you're concerned, if I open a weekly bull put or a weekly sell a naked 58 put, is that a good price? Or I'm thinking about the 59 because the stock's at 59.44. And they say, oh, but the strike of pain is at 58. Well, maybe that should be a price you'd use. Maybe give you a little bit more safety. But again, if the 59 has the probability you want, the return you want, the delta you want, and the risk you want for a strategy you're using, making that the pivot point of your sell for, let's say, a bull put credit or a bull call debit, naked put position, then follow your trading plan. Okay? This might give you a little bit better peace of mind. That might be better to go with the 58. I don't know, but personally, I don't use it in my trading. If anyone has an idea of or anyone has a comment on how you use strike of pain for your trading in any strategy, let us know. But I personally don't use it that often. And if I run the next test I told you about, maybe in a couple weeks I'll get some time to run a new test on that to see how it performs over time. If I find something very significant that I think would help my trading, I'll absolutely let you know, and I'll absolutely let you know how I'm using it for my trading. Right now, I don't have it, and I rarely look at it. Meaning that I rarely look at it for my own trading. Most of the time I'm looking at it is when someone asks a question about it. Okay, so that's recap of the strike of pain in there. All right, Sam, you had one other comment here. It says, when to sell naked puts when the stock is oversold. In my case, UVXY, you were signed at $9 naked puts, and then you sold the stock at 30. Then you bought the UVXY 15 and sold the 20. Now I'm on UVXY, have a straddle on it and selling calls and puts, okay? So you got to an oversold. And you know my kind of idea. We're at 1436 now in UVXY. Hindsight's 2020, but where would I sell puts? Here? No. Here. You know, Sam, we've had this conversation. When I see the stock start to come, any security, and I know it's dangerous because UVXY doesn't follow normal security. When I see it move above the 20-day moving average and I see a positive MACD, that's when I'm selling puts. When it's still confirmed, still selling puts, Bollinger Band selling puts. Here is still good. And I'm just following the same trends you do, but it's so hard to gauge with this. I wouldn't sell puts here. Not because I see it doing this, but once it comes back to the 20-day moving average and I have a confirming signal here with the MACD, I'm not selling puts anymore. I would have sold puts. I'm not selling puts on this right now. I can't give direct, I just mentioned earlier, I can't give direct advice, but below the 20-day moving average, MACD dropping just below the divergence, the positive MACD and the signal line still separating. I don't think I'm touching selling puts on UVXY right now. When I see that bottom hit, as it did over here, hello 23 RSI, MACD starts to change over like it did over here, and it goes back above the 20-day moving average. maybe I'm looking at it. Of course, we could see that whole pattern change right on Monday. Don't know what's going to happen over the weekend. Don't want to speculate anything happening, but hey, something goes wrong on Monday, folks, and the market drops down 6% at the open on Monday. I doubt it will. Not doom and gloom here, but we'd expect UVXY to pop up, and then everything would change in an instant. Probably be up at 25 to 30. This would be back up here. These would be back positive. This would be well above the 20-day moving average and the upper band. Right now, I think it still has room to fall back to this range. You mentioned 9. I think that's a good target. $10.50, $10, $9, that's a decent target, but I wouldn't sell until I see this reverse. Or this bounces off of 23, 24, 25, Sam. I know that's a similar pattern that you follow, but that's kind of what I'm looking at here, too, for these types of positions. Okay. All right. Well, now, Sam, you had a couple other comments I saw in there that I threw into the discussion, but I had mentioned the CARB, and you mentioned another position as well that you were looking at, but I don't see any other questions right now that have come in. Oh, that didn't work. Why not? Okay, sorry, folks. I'm trying to get back to something here, and everything just sort of went wonky on me. There we go. Okay, so I just wanted to remind everyone, today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any of the stocks that are options discussed today should not be taken as direct trading suggestions. Strategy discussions, of course, of how to build spreads are there, but as we discussed, that might not match your specific needs. Options, of course, involve risk. May not be suitable for all investors, and I copied this, obviously. Markets are open on Monday. They weren't open on February 19th, but we're talking about March 19th, and the markets will be opened as well. Okay. All right. Now, this is a strange question. A last-minute question came in. Will, I don't know if I'm gonna just touch on this briefly. Oh, I'm sorry, Mike had another comment too. They all just came in a minute. Mike A says, if Trump refuses NOKO and the market plunges, not advisable to place a bear call on SPX. No, and you'd want to have that in place beforehand if you thought SPY was hitting the top, taking in anything there as well, right? Because, even after the drop, I don't want to necessarily do a bear call on SPY after the event happens because it's likely to recover. I agree with you, Mike, in that case as well. Will says, usually for calendar spread, it's hard to predict the profit and loss at front expiration due to IV change compared to vertical. Yeah, calendar spreads are sort of a mathematical game. You can see the profit and loss chart of a diagonal, or I buy an in-the-money call, maybe far out in time, and I sell an at-the-money call, and I can expect what my return would be, but that's based on a theoretical price of what the option's worth. That's the best we can do. So is there a good way to analyze a calendar spread? Find some, yeah. Okay, also, which is better, a long calendar or a short calendar? I do long calendars, Mike. I do long calendars, Will. Diagonals personally. Buy a call 5 to 6 months out in time, slightly in the money, and sell the at or out of the money against it. I don't like doing the reverse. It's not really called the reverse, but where I'm selling an out of the money, buying an option that's 2 or 3 months that's further out of the money, trying to do a credit. I don't like doing it that way. So I think if that's what you're calling a long calendar is the true diagonal spread, then I think that's better than doing the one where you mentioned the reverse. And what is the best way to avoid volatility crush? Well, we kind of saw that. When I used the search for naked puts and we were talking, or long calls, we were talking to Rajiv about looking for the implied volatility. When I'm opening a diagonal spread, I want that long option. Okay, I want the long option to have a relatively low percent implied volatility range, so I'm not buying into high implied volatility. The short, I'm not too worried about because I'm hoping that goes to zero and the max return is calculated off of going to zero. But you're right, I don't want to experience a large fluctuation in that case. Okay, so I'm going to look for calls far out in time for my diagonals where the implied volatility range is near the bottom end below 20%. Not up the high. Okay. All right. And last but not least, remember, if you haven't tested out PowerOptions, just go to powerop.com, put in your name and email address, and we'll send you a password to start your trial. Subscription levels start at $40 per month for end-of-day data, and then go up based on if you want 20-minute delayed, the real-time service, or access to the backtesting tools that we took a little bit of a look at today as well. Remember, if you want other free information, free education, I should say, not free stuff, go to blog.poweropt.com and you can check that out and see some of our articles. You can always check out the webinars page. We referenced that twice today, or go to YouTube and search for Power Options. And of course, you think of any other questions at any time, send me an email to support@poweropt.com, or you can send me questions to support@radioactivetrading.com. You can also call the market during office hours, okay, there. And Sam mentioned he has the spread that we can talk about next week that he opened with Verizon on the diagonal. There, calendar on SP. Calendar spread, not calendar SP. Calendar spread on Verizon, 47 July calls and sold the 48.50s. Okay, so we'll take a look at that next week as well. Oop. All right, ladies and gentlemen, thank you so much. Have a fantastic weekend. Happy St. Patrick's Day for those of you that are celebrating, and happy great weekend to those of you who aren't. We'll see you soon. We'll have some other information, other presentations for you next week, in addition to being back on Friday once again for our open forum Q&A session. Take care, everyone. I hope you enjoyed the presentation. Good night.